they start losing money in their conventional investment strategies. And that's why a bear market is so important to this sort of line of reasoning. Once you start feeling less confident in your FA's recommendations to be long, the usual garden variety of overpriced stock, you're going to start asking questions and looking around. And I think that's the thought process that will lead money to flow into gold. And believe me, I think that there will be continued surprises on the upside if we have an equity bear market. Again, in the very early stages, but I think I think that's where we're headed.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a great discussion lined up, and we're fortunate to have with us John Hathaway. John is a managing partner and the senior portfolio manager for Sprott Asset Management. He has more than 5 decades of experience as a portfolio manager, founder, and certified financial advisor. John, thank you so much for joining us today.
Pleasure. Thanks, Gary.
So let's begin with the Fed and their likely upcoming rate cuts. Unemployment is going in the wrong direction, and many companies are planning layoffs, initiating layoffs, or even downsizing or going out of business. Even a 50 basis point rate cut won't put people back to work for a very long time. That won't increase demand for gasoline, a bellwether for everything in the economy, for a very long time. We're borrowing and spending $1 trillion every 90 days just to stand still, and we're falling, albeit slowly, but so is everyone else, so it's harder to see. So OPEC cut nearly 6 million barrels a day, which is 6% of global production, and yet prices are still falling. These trends in demand and unemployment, they're not bottoming, they're accelerating. Do you expect things to get better or worse from here?
Well, I think the Fed is behind the curve as usual. What's, to me, most important to point out is that the market, the financial markets, particularly the stock market, has been trading on the expectation of a rate cut. And whether it's 25 or 50 basis points doesn't matter, in my opinion. It won't change anything, I think, as you said in your lead-in. So I think when they cut, focus will start to turn to poor corporate earnings, worsening economic numbers. And in all of that, I would see, and I think we're already there, in a bear market, probably an extended bear market. And probably multiple rate cuts and a resumption of QE and all other crazy stuff. And probably, because it's an election year, maybe some stuff on the fiscal side that nobody's talked about. It isn't going to do any good because the forces that are forcing us into recession are well in place. And, that includes a dramatic slowdown in liquidity, the rate of growth of money supply. You mentioned employment trends being negative. If you just look at some of the corporate earnings, like Dollar General is a great example. That is the lower end of the bottom of the pecking order in terms of consumers, and those poor people are living from paycheck to paycheck, and at the end of the month, they don't have enough to spend. And that's what Dollar General said in their press release regarding their negative earnings surprise. So to me, the Fed is just out of touch, looking at the wrong kinds of things, and the market has been buying it hand over foot. To me, Gary, the markets are very poorly positioned for what lies ahead, and that is a bear market, a recession, and I think that will ultimately prove very positive for precious metals.
So, John, government spending, it appears to be the only reason that recessionary forces dragging down the private sector have taken so long to prevail, keeping alive the soft landing narrative. Year over year growth in government spending has exceeded 20% in recent months.
Right.
That spending is going to be financed by increased government debt issuance. Yeah, as you talked about, which in turn is going to deepen the concerns as to a sovereign debt crisis in the absence of real economic growth. Does the increased deficit spending lose its ability to prop up the economy at some point in the near future? And if so, what are those ramifications?
Well, the answer is yes. I mean, one of the great surprises that we could find out in the next 6 months or a year is that the old playbook of increasing fiscal spending may not have the zing that for economic growth that it historically has. And I think each round of fiscal stimulation over the last 20 years, let's say, it's had a smaller and smaller impact on growth. So could we be in a situation where fiscal and monetary policy are just churning their wheels and not working? I think that would, if that were to happen, and I wouldn't rule it out, we could see gold double from here.
So I believe that's the term for this is the law of diminishing returns.
Right, exactly. Yeah, and we played that old playbook forever. And you mentioned sovereign debt crisis. Well, who's going to buy our paper, especially on the long end? We know that they've trimmed the auctions sizes of anything with duration. So everything is being financed on the short end. And that is what banana republics do.
Yeah, and I believe, the returns of the last round of QE was about 55 cents on the dollar. It wasn't even more than $1 return for the dollar that they put in.
Right. I think, a lot of people, including Lacey Hunt of Hoisington, has pointed this out for quite a while, that the returns on government stimulus are actually negative.
Yeah.
But that's all we have left.
Well, speaking of Lacey, he speaks a lot about the net national savings. It's negative for only the second time since the Great Depression. Literally over the last 100 years, it's been negative only one other time, and that was 2008 during the Great Financial Crisis, when they said, look, we're headed towards possibly the next Great Depression. Why is the negative net national savings a very important metric that we should all be paying attention to, but yet very few are?
Yeah, you're right that nobody pays it. Most people don't even know what it is. But when you think about, again, the consumers for Dollar General, they don't have any savings. That is a recipe for economic contraction. When savings are, again, quoting Lacey because he's such a great economist, the only way out of this is a period of austerity, extended austerity, and that is not in the repertoire of any politician around.
Right.
The idea that we would tighten our belts, God forbid, that people would, stop spending and start to save. That would be the answer to these issues, and then probably more enlightened economic policies on the other side. I don't see that happening without a deeper recession and certainly a lower stock market, probably higher bond prices, lower interest rates for some period of time. Believe me, that is not on anybody's radar.
Yeah, you're absolutely right. I believe Kamala Harris has put out some policies that she wants to enact if she becomes president, things like, a $6,000 per child tax credit, $25,000 for new homeowners that have successfully paid their rent over the last 24 months, and $50,000 tax write-off for startups. And then on the other side, I believe Trump has come out saying, look, I'm going to put tariffs on everything, and from vehicles to any country that is no longer or even trying to shy away from the U.S. dollar, we're going to impose 100% tariffs. All of that is inflationary, isn't it?
It is, yeah, from a different paths to it, but
And not focusing on austerity.
I didn't hear you say austerity once.
Yeah.
I don't think anybody could get elected on, well, we're going to tighten our belts, we're going to lower our spending. Maybe we won't take as many vacations in Europe or wherever. Can't buy that RV. I don't hear anybody talking about that.
No.
And unfortunately, something like that, and that's what you had in World War II. Everybody got behind the idea, we're tightening our belt, we're all pulling together. I think that was the last time you could point to when we had extended austerity, and it was a consensus thing. Everybody agreed with that. Just imagine what has to happen to get people back on side for that kind of outlook.
It seems like it would be complete societal chaos.
I don't like to go there, but it is definitely a long way from the mentality of the political body and the consumers, and frankly, business and economic leaders. I don't think people think like this.
Mm-hmm.
So it's one of those things that ultimately will come to a head. And, I have no idea the timing, but the path seems to be pretty clear. And that's why investors should have some exposure to gold, because everybody's excited. Not everybody, nobody's excited except me that the gold price has done really well in the last few years. It's just another way of saying your purchasing power is going down, and you're losing wealth if the gold price is going up. It's a signal that nobody understands. And again, how do you protect yourself? Well, you own gold, and that way you maintain purchasing power.
So, John, the movement by BRIC nations to circumvent U.S. Treasury bonds or to de-dollarize as a neutral reserve asset to recycle trade surpluses, it's beginning to gain traction. And DC is even noticing. As I mentioned earlier, Trump came out and he repudiated this idea. He stated that he was going to slap a 100% tariff on countries who are sidestepping the dollar. But the weaponization of the U.S. dollar in response to the Russian invasion of Ukraine in February 22, that was really the catalyst to this whole movement. What are the implications of the de-dollarization efforts by the BRICS that you're expecting and watching for, understanding that right now it's happening on the margins?
Right. It's still in its infancy, embryonic stage, let's call it, but it is gaining traction for the reasons you cited. What are the implications? One is trade balances, surpluses, deficits among BRIC countries will be settled in part by transfers of gold. And you're beginning to see that. The other thing, and I think it's probably even more important, is that the use of the dollar and U.S. treasuries as a way to recycle surpluses is diminishing. And that means that at the time that treasury issuance is going up, as we talked about earlier, the offshore pool willing to absorb that is shrinking. Mm-hmm. And so what does that mean? That means probably if you had a fair market for interest rates, instead of a managed long-term interest rate, rates would be much, much higher than where they are. And what are the implications of that? Well, higher rates equal lower equity valuations, for one thing. So the trade, I can think, I'm sort of going off the reservation here, but I think of bonds as no longer being a safe asset. kind of for some of the reasons we just talked about. But I can see the trade. The trade is, if we go into recession, there will be sort of that Pavlovian reflex of going to safety. And so bonds probably are a good trade, but no longer a safe asset. So that 60-40 portfolio, risk parity kind of portfolio, may no longer work. And so where does that lead us? That means that we've got to find a safe asset. And, lo and behold, that could be gold exposure. I don't think we're not even close to that, but I think that's coming.
So evidence supporting a weaker economy, it's extensive. We've been talking about it throughout here so far. Yet it's really ignored by the investment consensus as, well, we'll just call it inconvenient, likely because it's supporting the historically high equity valuations that currently exist. A recession, as you've been saying, would lead to new bouts of money creation by central bankers. It would lead to fiscal excess and obviously monetary debasement by both sides, just as it has in the past. A recession, an event for which financial markets are really not positioned for at this time, would likely cause demand for gold to surge, just as it has in the past. In your analysis, is this exactly what you're expecting?
Right. I mean, we haven't really talked about it yet, but this rally in gold from slightly below 2,000 an ounce to where we are today, roughly $2,500 an ounce, that's taken place mainly because of de-dollarization and central bank buying. Mm-hmm. Now, the algos have caught on to this, so they're long. I guess the futures positions, they're kind of long. And they're trend followers. But if you look at the positioning of most wealth managers and their clients, it's at the lowest level in gold in the last 5 years. And so that shoe has yet to drop. And again, why will Americans and Europeans who have very low exposure to gold, why will they change their minds? I think the biggest reason is they start losing money in their conventional investment strategies. And that's why a bear market is so important to this sort of line of reasoning. Once you start feeling less confident in your FA's recommendations to be long, the usual garden variety of overpriced stock, you're going to start asking questions and looking around. And I think that's the thought process that will lead money to flow into gold. And believe me, I think that there will be continued surprises on the upside if we have an equity bear market. Again, in the very early stages, but I think I think that's where we're headed.
So, John, we're talking about sentiment really here. And according to Bloomberg, the consensus projection for long-term gold prices is for them to trend lower compared to current spot price of approximately $25.30 an ounce. In your estimation, how can the consensus thinking be explained in light of all of these macro forces that are around us?
I think it's another reflection of how poorly positioned the consensus is. I mean, to me, it's just absurd the reason we started looking at it is because sell-side analysts have models to value mining stocks. And so they have to have an expectation to plug into those models of where gold prices will be in 3, 4, 5 years. And so they just kind of take off-the-shelf projections by major strategists at all the big firms. Some are changing, some are chasing the gold price, but they're not chasing it they're chasing it in the moment. They are not willing to suggest that 3 or 4 years from now, the gold price could be 20, 30, 40% higher. Nobody is saying that. And therefore, they're not connecting the dots of de-dollarization, recession, and lower equity prices. I think that, and that, I hate to mention this guy's name, Al Gore, an inconvenient truth. And therefore, we're sort of blithely sailing off into this different world where, and yet the acknowledgement of that, the recognition of that, probably will only come through some pain for the everyday investor.
If your thesis is correct, then the majority of them are way off sides in their positioning, which means that likely the downside will be much stronger.
Right. Again, the amount of leverage in the system, everyone thinks, well, we can't have another GFC. Well, I'm not so sure I'd be comfortable making that statement. I'm not saying that we will have one, but I don't think the amount of leverage that is in the system is fully accounted for. And I'm thinking about private equity as being one example of this bubble that we're in. Everybody sort of looks and fixates on the Magnificent Seven, which have lost some luster recently. But, and then there's the non-bank sector, and pension funds, insurance companies are all loaded with this private equity questionable value. I'm really biting my tongue and using the right adjective. And I think that's that day of recognition that there's no there, or at least, the there is worth a lot less, is the sort of thing that can extend a downturn and, of course, lead to panicky response by policy officials.
Yeah. So gold has surged past that psychological $2,500 level that we have touched on here. It's been driven by factors that's not easily explained by traditional market variables. It really suggests that likely central bank and sovereign activity has been the major reason, not other usual market dynamics. In your analysis, what are you expecting from here over the next 6 or so months for the gold price?
Gary, I never make a projection with a number and a date in the same sentence. But I do think there's surprising there. I think there will continue to be upside surprises. Of course, we'll have occasional pullbacks, which I would recommend folks take advantage of. But sentiment is still right now is quite positive, but it's not reflected in the actions of investors. So I think the sentiment is a measurement of algos and robots and commodity traders. I don't think it's, if you ask the everyday investor whose accounts are managed by the usual firms, they're not doing anything. They're just holding tight and probably for the time being riding losing propositions down. So I think we're not even close to seeing that shift of positioning from retail or institutional investors towards precious metals. Again, I think part of it is because it is so inconvenient and contrary to received wisdom on no recession, soft landing, Powell's going to stick a soft landing and all that, and no recession and all of that. So that is the complacency that needs to be disrupted, and in my opinion, it will be disrupted not by some courageous strategist at one of the large firms saying, look, we're heading into a tough period here, own some gold. They'll be dragged into it kicking and screaming.
So, John, in Western capital markets, gold ownership remains at rock bottom levels, just like you've said. Disinterest, it's really astonishing in light of the fact that gold has outperformed equities and bonds since 2000. What is this and the relatively lack of commentary or analysis from mainstream financial media suggest for gold moving forward?
I think it's very bullish because it's, if you're a contrarian, and nobody's on board and it's going up, to me, that means it's got more upside. Surprises will come on the higher end of the price chart. I think once you start to see flows into ETFs, which we haven't seen yet, that will move the gold price. All we've seen so far, you mentioned two things that people don't care about: de-dollarization and central bank buying. Average investor doesn't care about that. What the average investor cares about is his portfolio invested in a lot of stuff which may start to disappoint. That will be the motivator to say, hey, FA, Mr. FA, or Mrs. FA, what about gold? And I am not saying that. The level of interest so far is zero from everywhere except for people like me, portfolio managers who actually care about it. It's a very, very small space.
So it's basically gold's going to continue to climb that wall of worry until two things really show themselves, and that is the advisors all in the Western world start telling their clients, hey, we need gold here, 5, 10, 15%, whatever it is. And the media starts sharing some positive sentiments, some positive stories, and some positive reasons to own gold.
Right. Well, to be honest, there has been some media coverage, but it is like a drop in the bucket compared to what it could be. And again, the sort of accompaniment, which would be a more common acceptance of a recessionary outlook and the resulting policy efforts to arrest an economic contraction. That's nowhere to be found. You're starting to see people worry, based on these last month and a half or so. I mean, the market's made a double top. And I'm not a technician. I'm just quoting from some that I follow that I think highly of, and it hasn't gone anywhere since early summer. So hope springs eternal until losses start to pile up.
How do you explain the lack of interest and negative sentiment in gold? Is it strictly a function of the fact that tech and AI is casting a historic shadow over literally everything else in the investment space? Is it something else? How do you explain this lack of interest and sentiment? I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift, it's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with John as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video.